What if the dollar in your pocket is really the world's running opinion of America? Before you book a flight, buy imported electronics, fill the tank, or check your retirement account after a Fed meeting, the price of your money is already moving. A decision in Washington can make your Paris trip more expensive, change what foreign investors do next, and quietly hit exporters, factories, and hiring plans back home. That is not theory. U.S. consumer prices were up 2.4% over the 12 months ending February 2026. On March 18, 2026, the Fed held its target range at 3.5 to 3.75%. One day later, the European Central Bank also held rates steady and warned that the war in the Middle East was raising energy price risks. So this is not some dusty textbook story. This is the hidden price tag on modern life. Why is $1 not equal to €1, 1 yen, or 1 Vietnamese dong? Because an exchange rate is not just a conversion, it is a verdict. It is the world constantly judging which money looks safer, scarcer, more useful, more disciplined, and more likely to hold its value tomorrow. In other words, currencies are not just paper. They are reputations. For a long time, countries tried to give money a physical anchor, especially gold. That helped money feel harder and more believable, but it also limited how much governments could create. As economies grew and crises became more complex, the old gold-based system became too rigid. By the early 1970s, it had cracked, and the modern world moved into fiat money. That sounds technical, but the core idea is simple. Your money has value because the law recognizes it, the system circulates it, and people expect other people to keep accepting it. Modern money is not backed by gold, it is backed by organized belief. And belief is never distributed equally. Some governments are more disciplined, some central banks are more credible, some economies are more productive, some countries are safer places to store wealth. Some financial systems are deeper, more liquid, and easier to trust in a panic. That is why the foreign exchange market is not just a market, it is a live, global stress test for trust. The first thing that stress test punishes is inflation. Inflation is not just prices going up. It is your money being demoted. If your paycheck stays the same while groceries, rent, flights, insurance, and gas keep getting more expensive, your currency is doing less work for the same effort. And if investors think that decline will continue, they become less willing to save in that currency, lend in it, or build long-term plans around it. A currency does not break the day economists panic. It breaks when ordinary people stop planning their lives in it. Zimbabwe became one of the clearest warnings. Once inflation spiraled out of control, the currency stopped functioning as a trusted store of value. And when money stops storing value, people start reaching for alternatives. Foreign currency, hard assets, anything that feels more stable than the paper in their hands. People do not abandon a currency because they hate it. They abandon it because they no longer trust tomorrow inside it. But inflation is only the first layer. The next layer is interest rates, and this is where the story becomes very American very fast. When the Fed keeps rates relatively high, dollar assets can look attractive to investors around the world. U.S. Treasuries, money market funds, and other dollar-based assets may offer a powerful mix of safety, liquidity, and yield. But to buy those assets, investors need dollars first, so higher rates can strengthen the dollar. Money tends to move toward places where it feels both safer and better paid. But here is the twist. The dollar can rise for two opposite reasons. It can rise because America looks strong, or it can rise because the world is scared and still thinks America is the least bad place to hide. That difference matters, because a strong currency can be a sign of confidence, but it can also be a side effect of fear, high borrowing costs, or economic pain underneath the surface. Higher rates may support the dollar, but they also hit the real economy. Mortgages get heavier, car loans hurt more, business expansion slows down, hiring plans get delayed, households think twice before spending. So when someone says the dollar is strong, the real question is not, is that good? The real question is, good for whom? A strong currency is not automatically a healthy currency. Sometimes it is strength, sometimes it is strain. Now, go deeper. Investors are not just buying yield, They are buying a country's rule book. They care about whether contracts will still matter next year, whether courts are credible, whether the central bank looks serious, whether politics feels chaotic, whether capital can move in and out freely, whether a sudden policy shift, debt scare, or constitutional crisis could poison confidence in the money. This is where the United States still has a major structural advantage. The dollar is not dominant only because America is large. It is dominant because the U.S. sits on top of giant capital markets, massive treasury market liquidity, and decades of global habit. According to the IMF's COFR data, the dollar still made up 56.77% of allocated global foreign exchange reserves in the fourth quarter of 2025. That share is lower than it used to be, but it is still enormous. Reserve currency status is not just prestige, it is infrastructure. The dollar is embedded in reserves, trade, finance, collateral chains, banking flows, and investor reflexes. People hold dollars because the dollar is central, and the dollar stays central because people hold dollars. That is a very hard loop to break. Then there is trade. Currencies are shaped not only by trust, but by what the world needs from you and what you need from the world. If a country sells valuable goods, energy, services, or financial assets to the rest of the world, that can support demand for its currency and institutions. If a country depends heavily on imports, especially for fuel, food, or key inputs, it often needs more foreign currency to pay those bills. For Americans, a stronger dollar can make foreign travel feel cheaper and can reduce some pressure on imported goods at the margin. But it can also make U.S. exports more expensive abroad. That can hurt manufacturers, exporters, and regions tied to global sales. So there is no perfect exchange rate. There is only an exchange rate that helps one part of the economy more than another. That is why some countries manage their currencies tightly instead of leaving everything to the market. Belize is a clean example. It has long maintained a fixed exchange rate of 2 Belize dollars to 1 US dollar. The advantage is predictability. Businesses can plan. Consumers face less exchange rate surprise. The cost is flexibility. When you tie your money closely to a stronger currency, you also tie yourself to the discipline and the limits that come with it. You buy stability by giving up room to move. And that brings us to the question that always sounds brilliant for about 10 seconds. Why not just use one world currency and end the problem? Because one currency would not remove economic conflict. It would merge economic conflict. The euro is the best real-world example. It made travel and trade easier across much of Europe, but it also tied very different economies to one monetary system. So, when Greece's debt crisis exploded after 2009, the pressure did not stay inside Greece. It spread across the euro area because confidence, banks, bonds, and policy expectations were all connected. One country's mistakes can become everyone else's invoice. Now, imagine trying that on a global scale. You would not create one peaceful money for humanity. You would create one giant shared fault line. And that takes us back to the original question. Why is $1 not equal to 1 euro, 1 yen, or 1 Vietnamese dong? Because a currency is not just a unit of payment, it is a compressed story about a country. It tells you what markets think about inflation, interest rates, institutions, trade exposure, energy vulnerability, political stability, and the future discipline of the people running the system. Exchange rates move because those stories move. Markets are not just pricing money, they are pricing behavior. Money feels solid when it is in your hand, but its value lives in other people's expectations. That is why a central bank statement can move currencies in minutes. That is why wars can hit exchange rates before they hit store shelves. That is why trust can hold for years and then crack all at once. Most people think money measures value, but in the modern world, currencies also measure credibility, restraint, and power. So the next time you see an exchange rate, do not treat it like a boring finance number or a travel annoyance. Treat it like a live scoreboard for trust. Because in the end, the world does not reward the prettiest money. It rewards the money it believes will still behave tomorrow. And that is why the fight over money is never really about paper. It is about confidence. It is about discipline. And in the final analysis, it is about who the world still trusts when things get ugly. If you want the next video, we can go one step further. How countries deliberately weaken their own currencies, what a currency war really looks like, and why the dollar still sits at the center of the system even while the world keeps searching for alternatives. Thanks for watching.